Hello, everybody. We are so glad that you were able to join us. I think we have the full house here. We are just so grateful that you're able to join us for this wonderful presentation. Brina, if you wouldn't mind pulling back up that slide, that would be great. I am Amy Lampy. I'm your AFP board president for 2021. Yes, thank you. Perfect. Thank you. I'm your AFP board president for 2021, and we are kicking off this year with some great content. Gabe Roel Martinez, research director of Greater Houston Partnership, is here to talk about the Houston's economy and an update and outlook for 2021. Gabe gave us a little preview, and boy, are we in for a treat. This is so get your questions ready because and go ahead and put them in the Q&A during the presentation. And then after his presentation, we will answer those questions. So again, make sure to put them in the Q&A down at the bottom. Don't put them in the chat, put them in the Q&A. We are just so glad that you joined us here for 2021. We as the AFP board are here to support you as a membership. We're here to walk alongside you. We know last year was incredibly difficult for our industry, but everyone in particular, and for the Houston economy. There's so many unknowns and things that affect us as fundraising professionals. So I'm grateful to have Gabe's insights so that we might be able to take insights as fundraising professionals and be able to look at a path forward. We have a lot of resources. If you haven't checked out our new website, we launched a new website in December. So please be sure to check it out, log in. We have some wonderful programming that Brina has put together for us for the coming year. For right now, it looks like we will have majority of virtual programming at least until the summer. But as we have all learned the phrase very well, pivot, we will be pivoting and along with you and be virtual as long as we need to be, and then look at some in-person events coming up. So we have we are looking forward to being here with you in 2021. Here to be a resource if you have any questions about AFP or you would like to get more involved. Please feel free to reach out to us. You can reach out to me directly, or you can also contact our admin email on the site. There are job updates on our site, so please make sure to check out those job updates. Or if you're posting a position, please do that. We also have a survey that we recently sent to membership, so please take a moment to fill out that survey. It's just a brief 15-minute survey to see how we can best serve you this year. Again, it's my honor to be your president, and it is even more of an honor to introduce Gabe and have him take us through his wonderful presentation about the Houston economy. I hand it over to you. I think we have you on mute.
Yes, you do. Yes, I am. Okay. Yeah, thank you, Amy. I really appreciate being here. Thank you for letting me speak to your audience. We talked earlier, and I let you know that, right now I work at a nonprofit organization. The Greater Houston Partnership is Houston's premier business organization. And we get our funding through our members, and we go to our members for campaign capital projects that we need funded. And before this, I was at Interfaith Ministries for Greater Houston, and I worked in the finance department. So I know how extremely important, the fundraising professionals are to nonprofits and charities. So again, it's a pleasure to be here with you. I have a lot I want to cover, so I'm going to go ahead and jump right into it. So let me start sharing my screen. Okay, so I'm assuming, let me know if my screen is not up right now. But I'm assuming my screen is up. So, jumping right into it, 4 months ago, the University of Houston, their Institute for Regional Forecasting, released their economic update, and they stressed that ultimately it was the virus that remains in charge of the economics. Now, back in August, my boss, Patrick Jankowski, he's been monitoring Houston's economy for well over 35 years now. He likes to say that he's been through 5 economic downturns, and he agrees that the virus will ultimately determine the recovery. But now that we have multiple vaccines that are being rolled out, economic recovery right now really is a function of how quickly and effectively we can vaccinate the population. That's the most important driving factor right now. You know, according to the CDC, 1 in 16 US citizens have reported being infected. Only heart disease and cancer will have killed more Americans in 2020 than this virus. But until we get full vaccination, continued economic relief through the CARES Act is going to be very important. Just yesterday, the Biden administration announced their American Rescue Plan, which is 1.9 trillion relief aid. This is a very good step forward, especially aid that's targeted to unemployment insurance and business loans. So for this presentation, I thought I would recap last year, kind of first look at where Houston's economy was before COVID, then look at the initial impacts, take a look at the current job situation, we'll look at energy, and then we'll finish up on the job forecast for 2021. So, you know, where was Houston's economy before the pandemic hit? Well, back in February of 20, we were in what we considered a low to moderate expansion phase, right? We had come out of a very, very severe downturn in the oil and gas industry back in 2015 and 16. And by 2018, we were back to normal economic growth and performance. But by the fourth quarter of 2019, we were already starting to see a little bit of weakening in our economy. And that's primarily because of oil and gas. And it's important to remember that the strength of Houston's economy, right, its ability to create new jobs, it really depends on our key economic drivers. And that's energy, that's the US economy, and that's international exports. Before COVID, right, the major risk that was facing energy was falling global demand for oil. Back then, inventories were rising. Prices were kind of stuck in that $50 to $60 price band. All of the major oil forecasters were predicting continued declines in global demand. And by November of 19, we were already starting to see job cuts in that industry. Now, when it came to the US economy, when it does well, Houston does really well. Before COVID, the US economy was doing pretty well in terms of GDP and employment growth. It was a little bit weaker than expected, but generally the US economy was humming along. The big fear back then, if you remember, was a recession, right? Up to that point, we were in the longest US economic expansion on record, 10 years and 9 months of expansion, and it beat the previous record of 10 years. So there was a lot of concern that we were overdue for a recession. And then when it comes to exports, you have to understand that Houston is very much a Houston export-oriented economy. We are the #1 producer of foreign exports in the entire United States. In 2019, we produced 129 billion worth of exports. That's 42 billion more than New York and 68 billion more than Los Angeles. So the biggest threat before COVID was an expanded trade war. I mean, how many of us remember that trade war discussion that we were having, the tariffs that were being put in place? In Houston, our export growth was starting to slow because of that trade war. For example, China is Houston's second largest trade partner. And at one point, our trade with China had fallen 50%. Trade with both Mexico and Canada were also falling. So all of that considered, the partnership was forecasting 42,000 new jobs in 2020. And just to kind of put that in perspective, here we're looking at year over year employment change. And you can see in 2009, the financial crisis hits Houston. We lose 100,000 jobs. We are one of the first major cities to come out of the recession. And that's largely because of the shale oil revolution, right? We had hydraulic fracturing, we had horizontal drilling, and that gave us the boom years from 2010 to 2014. And then in 15 and 16, we have the fracking bust, oil prices crash. Houston loses 86,000 energy sector jobs, and we have 2 years of overall negative job growth. In 2017, we have Hurricane Harvey. It's the worst natural disaster in Houston's history. I was here. I remember the boats evacuating people all around my neighborhood. 125,000 rescues and evacuations. It's the third largest economic disaster in the US. But by the fourth quarter of that year, we had the Rebuild and Recovery Act or effort. And that recovery effort actually netted us about 24,000 new jobs. 2018 and 19, those were both pretty strong years for job growth. And then in 2020, we were forecasting that 42,000 jobs. The important thing to remember is that in a normal year, Houston's employment growth, it grows at an annual rate of about 2%. So on a base of 3 million payroll jobs, the region should add about 65,000 new jobs each year. But because the energy industry was taking a hit, we were expecting, slightly below normal growth in 2020. So that's kind of the picture of where Houston was before the pandemic. The question now is, well, when exactly did COVID-19 begin to impact Houston? So some important dates to remember. On March 4th of 2019, Houston had its first case of COVID-19. A week later, the rodeo shut down. It was the first known case of community spread. March 24th, we had a stay-home order issued for Harris County. Sadly, we had our first death on March 26th. And then on April 27th, the governor initiates the first reopening phase, but ultimately reverses that decision 2 months later on June 26th. So when we look at the business impact locally, here we're looking at DBAs and sales tax permits. These are kind of a good proxy for new business formations. The chart on the left shows assumed name filings in Harris County, right? So these are official filings to register your company so that you can do business in the county. And so the red line represents normal pre-COVID levels. And you can see that DBAs begin to really slip the second week of March, but then, continue sliding until they ultimately drop 98% by the end of March. And on the right, we see sales tax permits issued in the Houston Metro. In order to sell goods and services in the area, you need a sales tax permit. And so you see that same pattern, right? You see permits slipping the first week of March and then really bottom out in April. Looking at traffic volume on the left, again, that red line is, pre-COVID levels. And on March 28th, traffic drops 42%. For the most part, traffic has returned back to normal, but that's a very different story for downtown parking. So on the right, you see parking downtown dropped 87%. And it's still at very low levels, very far from recovery. And what downtown generally represents are office workers, right? This is accounting, this is consulting, marketing, legal. Much of this work can be performed remotely, and many of them have, and they continue to do so. I work downtown, 701 Avenida de las Avenidas, Avenida de las Americas, and our building has been completely empty, all the tenants, since March of last year. So because workers are working from home, they're not eating at restaurants for lunch. There's not a lunch crowd. And that's one of the reasons we're seeing so many restaurant closings, especially near Houston's office centers. And then looking at restaurants and residents staying home on the left, we can see that restaurant reservations just really flatline in March 23rd. And then on the right, the number of residents staying home jumps up 23 percentage points March 26th. Turning to public impacts, when we look at when the first spikes in our region occurred, you can see on the left-hand side, those are daily COVID cases by week. And we can see that the case count really starts to accelerate mid-June. That's week 13. And then on the right, hospitalizations really start picking up in early June, and then they peak in the 15th week. And then lastly, looking at infection rates and fatalities, you can see on the right, positivity rates really spike in late June. They hit 22.3%. And then fatalities really start to accelerate in early July, reaching 4,800 deaths by December 31st. So what we're seeing is that, business activity begins to fall in early March, following the lockdowns, following the stay-at-home orders. Then we have the phase 3 reopen on June 3rd, and we see the health impacts really start to accelerate 2 months later in mid-June. So kind of looking at the payment protection program, the first round, this was passed as part of the CARES Act, and it offers forgivable loans to businesses to keep their employees on payroll. And so the map on the left shows PPP loans in 5 different loan ranges. So you can see loans between 150 and 350,000. More than 8,000 of those were issued in our region. And the map on the right shows the number of jobs that were supported through these PPP loans. In Houston, PPP loans actually totaled more than 9 billion and reportedly supported more than 700,000 jobs throughout the Houston region. Now, one important note is that loans below 150,000 were not disclosed, and they represent 25% of the total loans and the total jobs. So the real loan and job counts are actually a bit higher. And when we look at PP loans per 100, we see that the average for the region is 22.9 jobs for every 100. And you can see that in the light blue bar in the middle. So essentially 1 out of 5 jobs in Houston was supported by the program. And you can see some counties proportionally receive more support than others. So Fort Bend had some of the highest levels of support. Harris County is just kind of right there in the middle. And then Walker County received some of the lowest funding per capita. Now, the industries, it's important to understand what industries are most impacted. And they're very diverse industries, right? Everything from restaurants, you have professional services, you have blue collar jobs like manufacturing, you even have religious organizations that receive funding. Almost every industry sector in our region was supported by the PPP loan program. It should be remembered, though, that the program, the loans were only meant to cover 2.5 months of payroll expenses. And that program closed back in August of last year. The good news is last week on January 11th, the US government finally reopened the loan program. They refunded the program. So this is another positive step forward. We should provide Houston some very much economic relief. So now that we are, 11 months into the pandemic, the question is, what is Houston's job situation right now? Initial unemployment claims are doing much better. They are trending downward, but they're still very much above normal. So initial claims are new jobless claims by individuals that are seeking unemployment benefits for the first time, right? And they've been holding steady below 10,000 per week for quite some time now, but they're still above the normal rate of 4,500 per week before COVID. Unfortunately, the most recent week that we have, January 2nd, you can see that claims have ticked up to 11,800, which is a signal that we can expect to see more layoffs to continue. 2 important things I want to point out, though. First, because of the pandemic, unemployment insurance was expanded through the CARES Act to workers that wouldn't normally qualify. So the self-employed, contract workers, part-timers, freelancers, even clergy members and religious workers, they were allowed to apply for unemployment insurance during the CARES Act. This expanded group of workers represents about 20 to 30% of these initial claims that we're seeing. And then secondly, if you wanted to know the total number of workers on unemployment insurance, you wouldn't want to add up all the initial claims because you get a lot of double counting, right? One person could file multiple claims, different times for different jobs. So a kind of better measure is continuing claims. These are ongoing jobless claims. These are individuals that have filed for unemployment benefits for at least 2 consecutive weeks. And you can see continuing claims, they give us a better picture of the total workers on unemployment. And in November, those claims totaled 86,000. But it's actually an undercount. It doesn't include those previous workers I talked about earlier who wouldn't normally qualify. It doesn't include the self-employed, the part-timers, and the freelancers. So this 86,000 that we're seeing, and all the other blue bars is an undercount, and it's an under about 20%. Now, the good news is ongoing claims are trending down, but the bad news is claims are still very, very high above normal. If you look back at the financial crisis in '09, claims only reached 69,000, and during Hurricane Harvey, claims only reached 41,000. The other bad news is that regular unemployment insurance benefits expire after 6 months. And so part of the reason we're seeing this drop off is because benefits are expiring, not because workers are finding jobs. When we look at the top industries for unemployment insurance, these are the industries that are still feeling a lot of hurt right now. And you can see we have both low and high income earners that are filing for benefits. It's not a surprise that temporary workers, restaurant workers are right there at the top. These jobs tend to be lower wages. They tend to be more part-time, but you can also see pipeline and oil field service workers. Now, these are very high paying jobs, easily with 6-digit wages. In the top 15, you also see school teachers, you see home healthcare providers, you see medical staff, and we're now seeing industrial building construction workers, which is another sign that Houston's industrial real estate market is starting to cool down. So those are some of the PPP loans. Those are some of the unemployment insurance. You can see what industries, what kind of workers are being impacted. Let's shift our focus now to actual payroll employment. So starting in 2010, you can see that we had rising employment during the oil boom. Then we had the fracking bust, the oil bust of 15 and 16, where employment is just kind of flatlined. We have recovery, and then employment reaches 3.2 million before COVID. Then in just 2 months, Houston loses 365,000 payroll jobs. After 7 months, we get a little bit of a bounce back, but we're not getting that really strong, that V-shaped kind of recovery that we were hoping for. When we look at monthly job growth, you can see that by mid-March, that's when employment starts to turn negative here in Houston. And then in April, just really severe, deep job losses. The equivalent of 6 years of job gains were just gone in 1 month. It's pretty bad. Those are big numbers, but as big as they are, they're not as big as other areas. So in terms of total job losses, when you compare our job losses to the other large metros in the US, Houston's losses are kind of right there in the middle of the pack. And if you normalize the losses, you can see that Houston lost 11 jobs out of every 100 jobs during the pandemic, which is much better when you look at Detroit or New York that they both lost 20% of their workers. Switching to job losses by industry sector, every major industry here in Houston lost jobs immediately after COVID. And what we're looking at here are job losses from March to November. And it shows how many jobs each sector is currently down since COVID. So you can see restaurants are still down 29,000 jobs. Construction is still down 24,000 jobs, and so on. What these numbers don't show you, though, is the degree of recovery that's happened within these industries. So some industries are definitely further along the road to recovery than others. 4 sectors have recovered all of their job losses due to the pandemic, but with a big footnote for 2 of those. So in finance, we have historically low interest rates. And these are driving record home sales, and we're seeing a surge in mortgage refinancing. And then because of the PPP loan program, banks were just absolutely flooded with applications and had to bring new people on to handle that program. So all of that was creating very strong job growth for the sector. The finance only lost 400 jobs in March and April, but they have since recouped more than all of those jobs back. In professional services, that's where we find, legal, engineering, accounting, technical consulting, public relations. Job losses were pretty minimal in this sector because much of this work could be performed remotely, right? Professional services initially lost 88,000 jobs, but they have since recovered all of those jobs so far. And then in retail, the early stay-at-home orders though, that required non-essential stores to close really had a big impact. Only grocery stores, hardware, liquor stores were considered essential early on. Eventually, those stores have reopened. Consumers began spending, less on experiences, less on going out to the movies, less on traveling, less on, maybe spending a night out on the town. And they started spending more on things like home improvements, on furniture, on sports equipment, and of course, spending a lot more on groceries. So, retail picked up for that reason. And it also picked up most recently because of the holiday shopping season. But that is temporary. These seasonal workers that were picked up for the holiday season, they will be let go this month and next. And the same is true for transportation and warehousing. Much of trucking really depends on retail sales, right? Shipping to stores, shipping to distribution centers, warehouses, really pick up during the holiday seasons. You have e-commerce, you have holiday shipping and home deliveries. But again, all of these seasonal workers will be let go. Trucking also depends on factory and construction activity, right? So transporting raw materials, building materials, finished goods. And right now, Houston's construction and manufacturing industries are in a slump. You also have aviation. Aviation continues to have layoffs in the industry. The airline industry is still struggling. And so while retail and transportation have recovered all their jobs as of November, now that the shopping season is over, we can definitely expect to see job cuts early this year. The next four sectors that we're looking at are doing, they're making pretty good progress towards recovery. So we have educational services. That's where we find private and public elementary schools, junior colleges, universities. We find the technical schools and the trade schools. The initial shock of the pandemic caused 5,800 jobs lost in this sector, but now that schools have reopened, employment in education is at 93% recovery. And in admin, that's where we find waste collection treatment. We find janitorial building services. And as we have reopened the economy, the need for clean workspaces, the need for more frequent sanitation is creating jobs. But admin is also where we find temporary workers and contract workers. And during recoveries, businesses tend to first add contract workers before hiring full-timers. And we're seeing that same kind of pattern repeat itself now. In health and social assistance, that's where we find the physicians, home health, nursing care, daycare. On the healthcare side, what we're seeing are that patients are still delaying elective surgeries. Patients are avoiding non-COVID medical procedures. And in social assistance, I think all of us can agree it remains a very challenging environment for the nonprofit and charities right now. And then restaurants and bars, they were hit very, very hard during the pandemic. More than 100,000 jobs were lost initially, but consumers seem to be a little more comfortable dining out. They've adapted to food delivery to pick up. But as we continue to experience COVID spikes, restaurants will be one of the first industries to suffer. These next industry sectors, are still struggling. They still got a way to go before they get to recovery. In other services is where we find things like personal care. So that's where we'd find the hair, nail salons, dry cleaners, personal trainers, wedding planners. You also find repair services for things like automobiles and appliances. You also find business organizations, religious organizations. These are all very high touch, kind of close contact services. The industry so far has only recovered 43% of its losses, but this is another industry that will suffer first during these COVID spikes. And then in government, of course, that's city, county employees, the courts, the police departments, state and federal employees. That's also where you find the central administration for publicly funded education. So like the Harris County Department of Education or the HISD administration. The job losses in this sector are really tied to lost revenue and taxes, right? With the pandemic, sales tax are down, hotel occupancy, alcohol beverage taxes, all of those are down right now. Because of that, government budgets are really tight right now. In arts and recreation, we find the theaters, the museums, the sporting events, gyms, concerts. This sector was hit especially hard during the pandemic. In the first month of the pandemic, this industry lost half of its total jobs in that first month, and recovery has been really slow so far. We saw some recovery during the summer vacation season, summer camps, theme parks, outdoor activities, but all that's pretty much ended now that school is reopened. And then in hotels, they're continuing to suffer from just low business travel and canceled or delayed corporate events. Houston's Comic Palooza was canceled last year. The Offshore Technology Conference that easily brings in 50,000 attendees each year, that was canceled last year, and it's being delayed in 21. The Houston Rodeo, the International Quilt Festival, the largest in the world, canceled last year and delayed this year. In construction, single and multi-family home construction is doing very well, but it's the public works and the industrial projects that are really suffering and really falling off. So construction of warehouses, industrial space has really dropped off. Those big industrial projects have been put on hold. We're finding chemical plants and refineries, they've paused their maintenance programs. And on top of that, we still have 50 million square feet of vacant office space here in Houston. In information, that's where we find traditional media. We find newspapers, book publishers, video, sound recording, radio. In both Houston and the United States, this sector has been shrinking for a long time now, partly because a lot of people are getting their information from other sources, social media or online platforms. And then lastly, in real estate, even though single family home market is doing exceptionally well, I mean, we are selling single family homes at record levels right now. It's the lease activity in commercial real estate that's really dragging this sector down, and also heavy equipment rentals. We're not renting tractors, we're not renting bulldozers, machineries, cranes. All of this is down because there's a drop in construction and there's a drop in oil and gas projects. We're also seeing car rentals, office furniture and equipment rentals are all down. So these are the industries that are kind of struggling. And then lastly, unfortunately, we have a few industries that are still losing jobs. Looking at wholesale trade, a lot of wholesale is tied to the oil and gas drilling and to the related manufacturing. Wholesale initially lost 17,000 jobs in the first 2 months of the pandemic, but has lost an additional 1,200 jobs since. In mining, that's the industry where we find exploration, we find drilling and oil field services, and I'll talk a little bit more about this later on. And then in manufacturing, nearly all the losses in manufacturing are due to the downturn in oil and gas, particularly in durable goods. So, about a third of all the manufacturing that takes place here in Houston is tied to upstream energy. So the drilling parts, the fabricated metal, and all the equipment. So that's kind of a summary of all of the industries. And in total, what we know right now is that Houston, initially lost 365,000 jobs in March and April. In April, we've recovered about half of those jobs so far, but we still have 184,000 jobs to go just to get back to those pre-COVID levels. So that's kind of the job situation. I'll switch over to now talking about energy. I think it goes without saying that Houston's energy industry is that Houston is the energy capital of the world. We say it all the time, and that's because every segment of the energy cycle is here in Houston. Hydrocarbon energy, petroleum products directly account for 20 to 50% of our area's GDP. Before COVID, oil production was at all-time record levels. By 2020, we were producing 12.7 million barrels a day with only 790 rigs. The US had become the largest crude oil producer in the world. And this is largely due because of big gains in technology and big gains in efficiency. So the industry was actually producing 40% more oil with half the drilling rigs. The rigs had become bigger, they become more powerful, and they were increasingly more accurate and automated. And on top of that, we were producing more oil with fewer employees. So you can see the fracking bust really drove up worker productivity. The blue line is Houston's energy jobs. And you can see before the bust that peak employment was about 300,000. And then in the fracking bust during that downturn, we lost 86,000 energy jobs. Before COVID, almost half of those jobs had been recovered. But generally, low oil prices, weak global demand really started forcing job cuts in November of 19. So we can see that even before COVID hit, Houston was already losing energy jobs. Now today, after COVID, you can see that that our crude output is down 2.3 million barrels a day. And an additional 24,000 oil jobs have been lost since November of 19. And if we take the long view, right, looking back to 1990, you can see that today's employment levels in energy are where they were 14 years ago, right? That's lower than the financial crisis in 09. That's lower than the fracking bust of 16. And if we look at the rig count, the rig count is generally considered a really broad measure of activity in the energy sector. Today's rig count is still lower than during the fracking bust. The only good news is that we finally hit a floor back in August. Rigs are starting to come back online, and the current rig count has ticked up to 323. Now, one of the reasons rig counts are so low is because it's just, it's not profitable to drill new wells. A survey by the Dallas Federal Reserve, asked the question, what oil price is needed to profitably drill a new well? And what price is needed to break even on existing wells? And so the results of that survey show that, there's different prices for different oil plays, but across the entire sample, $50 was the average price for new wells and $30 for existing wells. When we look at historic oil prices, what we see is that prices hovered above $50 for most of 2018 and 19. Then COVID-19 hits, the world goes into lockdown, there's a massive shock to demand, and for the first time in history, the prices for oil actually turned negative. They hit negative $37 on April 20th. Prices eventually did bounce back to the $40 range, but you can see here that future prices are well below $50 for the next several years. And what that means is that for oil producers, the industry right now is just not that profitable. And if it's not profitable, it's not going to attract investors. So even before COVID, Wall Street was already putting the screws on the industry. Today, access to capital is even tighter. So here, what we're looking at is the S&P 500 index. That's the light blue line, and the Bloomberg Houston Chronicle Energy Index, the dark blue line. The S&P is 500 of the largest U.S. companies that are traded on U.S. stock exchanges, and the Houston Energy Index represents about 53 energy companies that are based here in Houston. Both of their stock prices have been indexed to May 1st of 2019. And you can see since May of 19, you can see that the S&P stock prices have risen 30%, while Houston's energy prices have dropped 30%. So the industry right now is really, really in an intense credit crunch right now. This lack of capital, you have low energy prices, you have low profits, are really starting to push many producers into bankruptcy. In the US, we have already had 88 energy companies file for bankruptcy since COVID. Now, I know that feels like a lot of doom and gloom for the energy industry, but there is always reason for optimism. Houston has always found a way to create jobs despite the ups and downs of the energy industry. In this chart, the blue line is total employment in Houston going back 3 decades. And then the purple line are oil prices. And what you can see is that during the 90s, oil prices were really flat. But still, even then, Houston was able to add jobs beginning in 93. And then if you look at the 2000s, we had a period of rising prices. And of course, we added more jobs. In 15 and 16, we had falling prices. And yet we were able to maintain our job base. And then finally, we had volatile prices more recently. And still, Houston found a way to add jobs. So the question is, will this pattern of growth, despite oil prices, continue, post-COVID? And that kind of brings us to our job forecast. Right now, the partnership is forecasting 35 to 52,000 jobs in 2020. Most of these jobs are going to be recouped jobs that we lost during COVID, and there will be some new jobs, but ultimately, this forecast depends on the success of the vaccine rollout. Most of the job growth will be in the second half of the year, assuming that enough of the population is inoculated to reach some kind of herd mentality by summertime. Now, the other major assumptions for the forecast are that in the first half of the year, we are going to see a surge in cases following the holiday season. We are seeing that right now. I think we're experiencing 4,000 deaths every day. Business projects will remain on hold as they try to figure out and learn what to expect from the new Biden administration or any administration. They always want to know, well, what are the regulations going to be? What kind of tax policy is going to be pursued? What are the funding priorities? Many consumers are still deciding whether or not they're going to get vaccinated. Unfortunately, there's a lot of surveys out there showing that there is quite a bit of skepticism and fear about the vaccine. But essential workers, the seniors, those with underlying health conditions will be vaccinated. Layoffs in some industries will continue, especially now that the holiday season is over. But by the second half of the year, we expect vaccinations to start to roll out for the general population. That should be well underway. Hopefully, COVID cases will start to trend downwards. The CARES Act and the stimulus packages that are passed now and in the future should start showing positive impacts here in the United States. And then globally, vaccines should begin rolling out in all countries, and we should be able to start containing the virus. When that happens, we expect global growth to start picking up. We'll see demand for our exports rise. We'll see consumer demand that was really pent up during these kind of lockdowns and the stay-at-home orders will start to be unleashed. To meet all of that demand, we expect business projects to start, resuming their expansion projects. And then travelers will start booking flights. They'll start renting cars. They'll start traveling. You'll see gasoline, diesel, fuel consumption all going up. And hopefully that'll prop up the Houston's energy industry. Now, as for the low and high growth scenarios, the two biggest variables that will determine that are oil prices, whether they're above or below $50 per barrel, whether or not we have strong or weak growth in the national GDP, and of course, the number of new daily COVID cases. And when we look at the job forecast by industry, you can see that some industries are going to be starting the year with full recovery, like finance, professional services. Like I said earlier, retail and transportation is going to see job losses this month and next. But for the most part, all of the sectors are pretty much starting the year off in the red. So any job gains in 2021 are really just offsetting the losses from the previous year. So mining, for example, it's currently down 11,300 jobs. And in 2021, at best, we'll keep those jobs. But at worst, it's going to lose a few thousand more. So even if we have a high growth year in 2021, there's only two sectors that are going to reach full recovery. That's admin services and education. So you can see for many of Houston's industries, they're not returning to pre-COVID employment levels until a year or longer. I want to invite you to visit our website. You can download the forecast. There's a lot more information about each one of these industries. But lastly, putting these losses into perspective, 2020 will go down as the highest job losses on record. If Houston adds 65,000 jobs each year, We're expecting 5,200 in 2021. If you do the math, roughly that implies, 3 years till recovery. So I will wrap up with these final takeaways. Houston has recovered half of the jobs it lost during COVID. Several sectors are well on their way to recovery. For others, the recovery has been much slower, and for a handful of sectors, we're still expecting job losses. Full recovery is going to take several years because we're not seeing that strong V-shaped recovery. Monthly job growth is still not as robust as we'd like, and we have not yet seen another round of strong government action and aid. So significant job growth in Houston is likely a few years away. Houston's energy industry is in transition. It will go through another transformation. Oil producers, they have to find new ways to remain profitable because oil prices are expected to remain low for the long term. Now, during the oil fracking bust, the industry already cut all the fat and trim out. Inefficiencies were stripped out. Operations were streamlined. Staff reductions were down to the bare minimum. The industry has already made big investments in technology and innovation. They've seen big gains in efficiency and productivity, and now in this COVID phase, there's really nothing left to cut except for muscle and bone, or double down on innovation. Houston has always found ways to add jobs, even with low oil prices. So you saw in all the price stages during flat prices, rising, falling, Houston has always grown or maintained its employment. Can it do it again post-pandemic? That's the question. I believe it will. Houston is a can-do city. It's overcome obstacles in the past with grit, with ingenuity, with innovation. And that's really what our region's going to need moving forward. Now, there's a lot of big assumptions built into our forecast, but we believe that we're going to add between 35 and 52,000 jobs in 2021. But ultimately, the speed of the recovery will depend on the success of the COVID vaccine rollout. So I'll end right there, and thank you for your attention. I'll open up to any questions that we might have.
Gabe, that was truly excellent. I'll start off just with a quick, we have a lot of questions, a good amount of questions on the Q&A. Thank y'all for submitting those. Will we be able to have a copy of that PowerPoint?
I believe so, yes. I've already shared that, and I've been told it's going to be posted on your website as well as a recording of this presentation. So I won't distribute it directly to you guys, but I think AFP will get that to you.
Sounds great. Thank you again for your time. So we have a couple of energy related questions. Is the energy industry at risk of being eliminated, threatened by some high profile political figures? And with the oil prices, do we think more of the large energy companies will invest in renewables? So those seem to sort of tie a little bit together.
Yeah, there's a lot of concern about the Biden administration and enacting regulations that might stifle energy. But the truth is the Biden administration has very little impact on what the oil and gas industry is going to do. For example, if they were to ban fracking, if the Biden administration were to ban fracking, they would only be able to ban fracking on federal lands. Most of the shale fracking does not occur on federal lands. And in Texas, there's very, very little federal lands. Mm-hmm. So the Eagle Ford shale plays that are out there in West Texas, they're not going to be impacted by any kind of fracking ban. Additionally, if there were bans on offshore drilling, right now to drill any kind of offshore project, that is a billion-dollar project prospect over many, many years. Right now, energy companies just do not have the capital to even start any major projects offshore. They don't. As an example, I think it was last month, the Trump administration had their first bidding for the Arctic Wildlife Reserve to open up that area for drilling. Those were federal lands. And all of the big oil and gas companies did not even show up to that auction. So, the fracking ban on land, it only applies to federal land. It's not going to impact Texas. Offshore drilling, There's no appetite for that by the energy companies. There's no capital for that. So that's kind of one position to take. As far as transitioning to alternative renewable energies, I think the oil and gas companies, the major companies, are really taking this transition seriously. You've seen major investors pull away from investing in oil and gas companies. You've seen Blackstone, it's the largest private equity firm in the world. They've divested. The Norwegian sovereign fund has divested from energy funds. You have other institutions saying they're going to divest because there's an uncertainty about what the actual value of oil and gas that's still trapped underground. What is that value given this concern for carbon neutrality? So I think oil and gas companies very much understand the danger that carbon emissions pose, and they're really trying to address that. One of the biggest technologies that's going to help the energy industry is really embracing carbon capture, use, and storage. Tremendous potential there, and Houston really has the expertise to develop that. Carbon capture and storage right now, it's hard to find a commercial application for it, but right now the most profitable way to use carbon capture is to take carbon and use it for enhanced oil recovery. So you take all this carbon and you shoot it down a well and you get a lot more oil and gas. We have, and we are leading in that effort. We also have the infrastructure here in Houston to really push forward with carbon capture, use, and storage. We have the pipelines that you need, right? We have the geological formations you need to actually store that carbon. We have salt domes, and we have all these areas along the Gulf Coast where you can store that carbon underground. And we have the know-how, the engineering know-how. NRG Energy, based here in Houston, recently got an award for the largest carbon capture project just south of Houston. It's called Petra Nova. It's the largest carbon capture project in the world, and it's just right down south here of Houston. So that's kind of the energy, that's kind of where traditional energy is going. They have to go carbon capture. When we talk about, alternative energy, wind energy, solar energy, we are making some gains in that area. We know that there's 30 wind energy companies here in Houston. We know that there's about 100 solar companies here in Houston. Back in 2018, some of you might remember Sonoma Energy went public. It's the first publicly traded alternative energy company based here in Houston, and they work massive wind and solar projects. So we are seeing that transition here in Houston. The other thing I would add is that, when it comes to wind and solar, that might not be our strong point. Maybe offshore wind might be really strong, but the other areas where we find we have an advantage in the energy transition is, like I said, carbon capture, use, and storage, but also hydrogen, right? Everything you need to transport hydrogen, to move it around, to store it, we have here in Houston. We have the know-how to do it. It's the same as moving hydrocarbons. We also can take the lead in they're calling it a closed plastics economy, right? Where you take plastics and you reuse it for industrial purposes. You have to remember that Houston produces 44% of the nation's base petrochemicals, right? And petrochemicals are the building blocks for plastics. So the know-how to reuse plastics is really strong here in Houston. So there's a lot of a potential to transition for this energy transition. We can see that the energy companies are on board. We can see that they are feeling the pressure from investors. And we can also see that energy investors are also looking at how to jump into alternative energy, sustainable energy, carbon-friendly technologies. We're seeing a lot more growth in that area. So it's definitely the future for Houston's energy. Traditional energy is not going to go away, though. It's a massive industry. I mean, our trucks, our heavy industry, our airlines, our ships, our tractors, they don't operate with batteries yet. And so we're still going to be dependent on oil and gas for quite some time. But can we reduce the carbon footprint? That is the real question that the energy companies are grappling with right now.
Thank you, Gabe. We have a couple of questions related to the nonprofit sector. We know that the breakdown by the partnership was not specifically for nonprofit, and then within nonprofit, the various areas such as healthcare. Is that information or data available that could be shared with our group in that way? what we're looking for is just trying to see how the recovery of our particular sector.
So the information that I was pulling from it comes from a survey, the current employment survey, and all the job numbers that I was showing you are surveys that actually go out to 144,000 companies around the nation in different industries, and they get a feel for, job growth. And it's not based on administrative records. It takes longer for those payroll records to come in, for those unemployment records, unemployment claim records to come in. And that's when we'll get a really accurate picture of what's going on in those really specific industries. And that comes from a survey called the QCEW, the Quarterly Census of Employment and Workforce. Now, we have the QCEW up to the second quarter of last year. And in that survey, or it's not a survey, it's actual administrative records, yes, we can see exactly how nonprofits, how charities were impacted at a much more granular level. So I don't have those numbers with me now, but to understand how nonprofits, really granular level, how they were impacted up to the second quarter of last year, based on administrative records, yes, we do have that information, and I can try to share that with you after this.
That would be really, really helpful. We appreciate that. Because I think there's some specific questions on healthcare, loss of jobs. It just seems, and then the recovery, it seems that those jobs, and I think you answered this in your presentation, those jobs are net. They're jobs that are net. They're not going to be any new jobs. They're the jobs that we see that the growth that's going to happen next year is recovery of current jobs, correct?
Yeah. It's a lot of just kind of digging ourselves out of the hole that COVID-19 kind of threw us into.
State of, I know we only have 2 minutes left, but state of major conventions, conferences coming back to Houston. Are there any scheduled for the fall of 2021? I think we have some folks wondering if they should be having their fundraising events in the fall.
It really depends on the COVID vaccine and how safe people feel returning to in-person events, whether or not companies are going to feel safe allowing their employees to attend in-person meetings, and what are the liability issues associated with that. Mm-hmm. So companies right now are asking themselves, if I send an employee to an in-person event and they contract COVID, am I personally liable? So there's a lot of those concerns that are kind of holding things back, holding conventions and corporate events from going forward. So it really depends on that vaccine rollout. I did recently talk to Houston First. They kind of manage the George R. Brown Convention Center. They manage a lot of convention centers around, and they help attract events to the area. And from what I've heard from them, are a lot of the big signature events definitely not going to take place the first half of the year. They're all being postponed till summertime or afterwards. So we are, at least what I hear from Houston First, we are expecting conventions to start taking place in the second half of the year. That's what we're seeing.
Well, thank you. This has just been incredibly helpful. We have a couple of questions we're not able to get to, so we will send those to you directly for some answers and get those answers back. So we really appreciate your time, Gabe. This has been truly enlightening, and we appreciate the partnership.
Well, thank you. Thank you very much. Visit our website. There's a lot of information there. Download this report. There's a more detailed analysis, but thank you for your time and attention.
Thanks.